Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. So the stock market today is down 1.1% on the Nasdaq, 0.4% on the S&P, and nearly flat on the Dow. Let's take a look at the different sectors. Leading today were defensives, utilities, and real estate. Lagging were cyclicals, energy, tech, and communication services. So this was a full-on risk-off move. Market participants are taking risk off the table, heading into a critical event, and I'm talking about this, everybody. The FOMC minutes are coming out at 2 p.m. Eastern Time this Wednesday. Now remember, this week is going to be a shortened trading week. This is going to be a long holiday weekend, with the market being completely closed this Thursday and closing early at 1 p.m. this Friday, thanks to Thanksgiving. Happy Thanksgiving to all of you legends. And what's very interesting is that going back a long time, the back half of Thanksgiving week tends to be a very bullish week for the stock market. And so barring any surprises, nasty surprises from the FOMC minutes, the market should see a nice rally in the back half of the week. I'm talking about Wednesday and Friday. All will come down to the FOMC minutes. And let's take a look at the daily chart and look at that. Just a meaningless doji candle, nothing happening today, really low volume. Thanksgiving week tends to see some of the lowest volume, and so no surprises there. Today has been bad for both the bulls and the bears because there's not been any action really. But in the medium term, we're still in a bullish uptrend. We're still above the 9-day moving average and the 20-day moving averages. The PPO is still trending up. And so far, so good, because if we go back and look at every single rally, bear market rally this last year, the market actually held the 9-day EMA. We saw that happen in the summer rally. We saw that happen in the May rally, as well as the March rally. So we need to see the stock market, the S&P 500, hold this 9-day EMA going into the FOMC minutes, and we need to see a positive reaction following the release of the FOMC minutes at 2 p.m. There's no doubt that the FOMC minute release is going to be a market-moving event, either violently to the upside following traditional seasonality, or violently to the downside going against historical seasonality. Let's take a look at the triple Qs. Same thing here with the triple Qs. We're barely holding the 9-day EMA. We had the triple Qs break the 9-day EMA twice in the summer rally, once on July the 26th and once again on August the 9th, and both of these marked stock market bottoms. In this instance, however, I actually expect the triple Qs to continue to move sideways tomorrow and into Wednesday until the FOMC minutes are released, at which point, again, either boom to the upside or boom to the downside. Let's take a look at the triple Qs divided by the S&P. This is a ratio chart that looks at risk on divided by risk off, because the triple Qs tend to be a more heavily weighted ETF towards tech and growth stocks, whereas the SPY is a more relatively balanced ETF. Now let's take a look at the 2-hour chart, and we're actually sitting at a critical level here, the 50-period moving average on the 2-hour chart. We actually need to see the triple Qs hold these levels as the market continues to move sideways in the next couple of days. Now let's take a look at the Dow Jones Industrial Average. The Dow is actually leading. The Dow is leading again, indicating that this has been a risk-off environment the last week or so, and that's actually to be expected. The market is extremely nervous going into the FOMC minutes release on Wednesday. Now let's take a look at the smart money. The smart money is up top, the dumb money is down below. This is the smart money dumb money indicator, buy and sell signal. So far in the short term, there's not actually been any clear buy or sell signals. We did have one small bullish divergence 3 days ago, but it did not play to the upside. We had a few bearish divergences in the last few weeks, both of which did play to the downside perfectly. And as of right now, we do have one medium-term bearish divergence where the S&P 500 is actually taken out, the October 28th high, while the smart money, the HYG, has actually made a double top. Now, this divergence would only be meaningful if the market breaks down decisively on decisive high volume Wednesday, because we've had similar divergences in the past that did not play out, and this is an example that I want to show you. This divergence developed in late October, where the S&P took out the early October high, while the HYG actually failed to take out that high. But in the subsequent 3 days, the HYG managed to take out that high, invalidating this divergence. And so I'm not ready to call this neither a buy or a sell signal at this point. I need to see the market reaction on Wednesday. Let's take a look at the VIX. The VIX has now put in a double bottom formation. And on the shorter time frame, the 2-hour chart, it's been putting in a slightly higher low. So we're seeing a bit of a bullish divergence for the VIX. But this divergence is meaningless unless we start to see the VIX ripping back to the upside, confirming this divergence. Now, with that being said, we're extremely close to a bullish crossover on the PPO. And remember, guys, a bullish crossover on the PPO for the VIX is bearish for the stock market, because a VIX that's moving up indicates that volatility is moving up and the stock market moves in negative correlation with high volatility, meaning when volatility shoots up, the stock market tends to sell off. We got really close to that crossover, but it failed the last several days. So far, this tends to be a small bullish hint to the upside. Again, we don't know. We will not know until those FOMC minutes come out, and we have to read them very carefully and see if Jay Powell and the gang continue to talk up the possibility of a pause early next year, and that would be very bullish for the stock market. Let's take a look at another divergence here. This is the Dow Jones Industrials up top, and down below is the Dow Jones Transport. This is called Dow Theory. Dow Theory dictates that when the Dow Jones is leading while the Dow Transports are lagging, it indicates weakness in the market and a potential reversal to the downside. Now, unfortunately, this is not a great market timing tool. I talked a lot about this in the last several videos and a lot in the Discord trading community, and that's because a lot of these divergences have not been playing out. And I'll show you several examples. Look at this divergence, higher high, while the transports put in a significantly lower high. But again, the market ended up rallying anyway, invalidating this divergence. We had several divergences just like this. Another one was right here. Boom, again, another lower high. The stock market ended up rallying yet again, so it did not matter. So this is not a great market timing tool. I much prefer the VIX sell signal and the smart money sell signal, both of which have not been triggered just yet. But still, I'm keeping this on my watch list because I'm noticing another divergence. Look at this. The Dow Jones has been rallying much more powerfully than the Dow Transports, which have been actually forming somewhat of a bear looking flag. Again, this is meaningless until we see the market reaction on Wednesday. Let's take a look at Tesla. Tesla has actually been developing this bullish descending wedge pattern. A breakout out of this upper resistance line would confirm a bottom in Tesla and a rally to the upside. We also have a significant bullish divergence on the daily chart, and we're getting really close to a key support level. Now, this entire zone right here is actually a vacuum, an air pocket, and Tesla price action, because there's not actually a lot of volume traded here. But then again, there's actually this little pivot zone right here where I expect Tesla to hold. And that's because of a chart that I want to show you, and it's this. This is a ratio chart that looks at Tesla relative to the triple Qs. And we're sitting at extreme oversold levels. Look at this. We haven't seen this extreme oversold level since, look at that, the bottom in March of 2020. Again, another bottom in May of 2019. It marked significant bottoms in Tesla. And on top of that, look at this. We're now hitting a significant level of support where we saw significant buying of Tesla in the past in mid-2021. In fact, I talked about this exact development in the trading community. By the way, everybody, this is what the trading community looks like. I talked about Tesla up top, and then I talked about another significant development, and it's this. the XLY relative to XLP. I'm talking about consumer discretionary versus consumer staples, the defensive. So the ratio is sitting at a critical level. We have a double bottom with a positive divergence. The last time we had a similar structure was after the May bottom. The ratio chart is taking a beating off the weakness from Amazon and Tesla, both of which appear to be bottoming with a positive divergence. I would be very hesitant to initiate a short here. I need to see one big green candle reversal in the next couple of days. If that happens, Amazon, Tesla, and the rest of the stock market is going to see an explosive rally. All falls on the FOMC minutes now. Hold on to your horns, bulls. I posted this about midday today. By the way, everybody, I'm at UTC plus 3, so 8:31 p.m. for me is about 12:30 Eastern time. And this is the chart that I'm talking about. Look at this significant bullish divergence, a double bottom potentially forming. Look at that. The last time we had a similar looking structure with a double bottom and a higher low on the PPO, we saw a significant risk on rally in the stock market the following several days. Now, I do need to see a reversal candle to the upside, a strong green day for this to be a confirmation of a double bottom. We haven't seen that yet. I need to see that in the next couple of days, either tomorrow or on Wednesday. Otherwise, this development is actually meaningless, and this ratio chart could continue to sell to the downside. So this could potentially be the beginning of a very powerful rally to the upside, especially in consumer discretionary stocks like Amazon and Tesla. But we need to see that confirmation. By the way, guys, I did initiate a couple of trades today, and I do post every single trade and investment that I make in the trading community. And I'm launching a special discount for this week, 50% off for the annual membership, which comes out to $25 per month. The monthly membership is $50, so I'm cutting that in half for the annual membership just this week. Please check out the link in the description if you are interested. Now let's take a look at the dollar index. The dollar index has actually found somewhat of a bottom, somewhat of a short-term bottom, and is now seeing some strength. But keep in mind, we're now tagging the 38% Fibonacci retracement level from the top of the prior bear flag, and this does still look like a bear flag. We could see a rejection of the 50% retracement level, at which point the DXY will be sitting at 108.4, which happens to be, let's take a look at that, bang, right at the level of the 5-week moving average. And this is happening as the S&P 500 is actually forming a bull flag. So be very careful here. The market does appear to be flagging and getting ready for an explosive move to the upside. Again, pending that FOMC minute release. Let's take a look at the 10-year yield. Again, the 10-year yield is still looking like a bear flag. That's just waiting to break to the downside. The 5-year note auction today actually saw yields significantly come down versus last month, which is a very positive development for the stock market, because as yields cool down, stock market valuations move to the upside, leading to that everything rally where price to earnings ratios expand and pretty much everything in the stock market moves to the upside. Let's take a look at the fear and greed index. It's sitting at 62. A greed reading, we're sitting above the 125-day moving average. We're flagging above it. That is a bullish development. Stock price strength is still strong. Breadth is still strong. Put to call ratio is still moving to the downside. Market volatility still declining. Safe haven demand still declining. Junk bond demand still growing. All bullish signals in the medium term. Now let's take a look at seasonality, and what do you know? Look at this. The market tends to bottom right around the last week of November. We're right at that window now where the market tends to bottom and rallies right after Thanksgiving well into December for that nice holiday November-December rally. So in summary, medium term, we're still bullish. Short term, we're still very indecisive, waiting for that FOMC minutes release. Long term, I am still extraordinarily bearish going into next year. I do think the market will rally well into the end of the year, but I do actually think that next year we'll see all of these prior lows get taken out. So again, short term, indecisive, waiting for that Wednesday FOMC minute release. Medium term, still bullish. And what do we have tomorrow, Tuesday? Really nothing going on except a few Fed members speaking. But I do not suspect that any of these speeches will be market moving. The market moving events are coming Wednesday with the jobless claims release as well as the FOMC minutes coming out. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.